He is finding pockets of opportunity within equities. Joining me now at Post 9, Rich Saperstein, Treasury Partners. Nice to see you again.
Likewise.
Where are these opportunities in stocks?
Well, markets right now are discounting the impact on the global financial situation from all the fuses being lit in Washington. And that's obviously the Doge, the layoffs, and cuts, and all the tariffs and everything. So I think we're going to have continued volatility. We're going to see reduced earnings. And I think that over the next 2 quarters, there's really no rush to aggressively go into the market and put capital to work.
So you literally would advise people just sit on your hands for a couple months. Let's just see how things work out?
It depends on how invested someone is. So if someone's not in the market, they probably should start putting funds to work now.
But I mean, I'm guessing that most of the people watching you right now are invested in the market to, to at least some degree. Who knows what their, cash levels are relative to how exposed they are to equities and bonds. But what if you are pretty well invested and you've enjoyed the past couple of years? You didn't sell at all on the downturn that we just had. What do I do then?
Rotate into high cash flow generating companies. So, for example, in the large cap tech space, there are certain companies that right now have operating cash flows of over close to 10%. In the utility space, as you know, I've been an owner of utilities for quite a while.
Yeah, but I mean, the Vistra has been one of the most volatile stocks in the market.
Yeah, it has. Vistra is a $40 billion company generating $5.5–6 billion in operating cash flow this year. They're going to buy back stock. They're going to only be growing. So as an independent power producer, that plus NRG at these levels continue to provide great opportunities.
When you're talking about mega caps, like what? I mean, you're essentially suggesting that you think these stocks have corrected enough?
Yes.
Even if the economy gets worse?
Well, the economy will slow down. There's no question. And if we look at where the market will go, let's say last year the market generated $245 in earnings. Put a 20 on that. That's roughly a 5,000 bottom on the market.
Why would I put 20 on that?
Because that's trailing earnings, and then you'll have 26 where a lot of this tariff tantrum and this entire doom loop that we're experiencing will probably be over by then. So I think you'll start looking at increased earnings into 26, so you'll start putting a multiple of, let's say, 18 on 26 earnings. So in terms of the market this year, I'd look for Q3 and Q2 to be more turbulence, more resolution of the tariffs, leaving Mexico, Canada, Eurozone, and China for Q4, and some resolution on that.
What about things like munis, which you've told our viewers you like for a long time? 2 weeks ago, the worst day in 30 years. I know some would say, well, that's where the opportunity presents itself. But given what's been happening with the bond market and interest rates, maybe I don't feel as comfortable as I once would have with even something that feels as safe as a muni.
We haven't seen these rates in 14 years. And the reason is that there was tax selling to pay taxes on April 15th, huge supply coming into the market. This week, 13 billion versus an average of 7 billion. Plus, one of Trump's advisors suggested reducing or eliminating the tax-free nature of munis. And you have volatility in the stock market leading to selling in the bond market. So that's raised the yields on these bonds to unprecedented levels.
You'd like to lock in some of the yields that they present?
Absolutely, because if the tariffs result in a slowing of the economy, that will result in lower interest rates, and that will raise bond prices, because if yields drop on bonds, the prices go up. So as a place to hold out and hang out right now during this volatility, plus have a great long-term investment, munis at 4.5–5% tax-free are exceptionally attractive right here.
Are your clients, like seemingly everybody else, hanging on every headline that moves?
Most people are, because Washington has really dominated the airwaves right now. And keep in mind that the tariffs today are impacting the market. And unlike 08 or 20, when we had great market declines, we had no way out of this. With the tariffs, it's one guy. He could basically start resolving a lot of these issues, making announcements.
You think he's going to do that? What do you mean we had no way out of the other things? The Fed came to the rescue, and so did the government with all the stimulus. But neither looks imminent in this case.
Well, in 20, we had no solution for COVID when the market dropped. In 08, the Fed had to come in and really rescue the market. In this case, the Fed does not have to come in. Will Trump resolve this? Well, let's think about this. Europe, you're charging me 10% on my cars. I want to send a caddy over to Europe. It's 10% tariff. We're only charging 2.5%. Either charge me 2.5% or I go to 10. Let's just resolve this. It's a binary outcome. It's all math. So I think these agitating discussions will get resolved, unlike what we had clarity on back then.